What's going on, YouTube? Welcome to the Credit Plug channel. So for today's video, I wanted to sound the alarm with what's going on at Navy Federal. So I wanted to share some updates on the recent call report. Now, as some of you might be aware, a couple months ago, I did an analysis looking at data. So every quarter, NCUA, so the National Credit Union Administration, which is the governing entity of many credit unions, right? Of which Navy Federal falls under. So every quarter they do release these call reports, right? So these call reports pretty much are reports just on the overall standing of the credit union, the financial health of the credit union. So you can literally go online and search, for example. So let's just say, you search for Navy Federal. And so what'll happen is, it'll share the latest cycle. So the latest cycle was just released for June 30th, 2024. Now, this was updated back in July 29th. Now, when I originally did my analysis, we were looking at the first quarter of 2024 and comparing it year over year to Q1 of 2023. So I wanted to share with you my latest analysis using the latest data on this June 30th, 2024 call report, just to share some of the latest, right? Now, again, this is public information, so I just wanted to share with you these exact reports. So as you can see right here, we have the March 31st, 2024 call report, just so we can zoom in, as you guys can see, March 30th. So again, this is the basis of my analysis, and pretty much what I've done was just take the data right here. So on Schedule A, it shares information on the loan. So delinquent loans based off of these different categories. So we have unsecured credit cards, payday alternative loans, non-federally guaranteed student loans, new and used vehicles, all other secured non-real estate loans, and so forth, as well as commercial loans, right? So I don't dive into all of the categories, but really just focusing on some of the top categories. So again, this was the call report for March 31st, and this is the new call report. So as you guys can see, this is as of June 30th, 2024. So I wanted to just share with you the findings that I've found. So I actually took the liberty of just transcribing this data onto an actual spreadsheet, so it's a little bit easier for you to visualize. Another thing that I am actually going to share as well, this is something I didn't do with the last analysis. So on the next page, Section 3, you have loan charge-offs and recoveries, right? And this is where it really gets interesting, because on this page, right, so Schedule A, Section 2, delinquent loans and leases, this only accounts to, current loan accounts, right? So after 360 days, the accounts will get charged off, right? So as you can see, when we're looking at these categories, so right here, it has just the dollar amount and as well as the number of accounts. They also share that information as well. But you're looking at the dollar amount and how many days delinquent, right? So over on the column all the way right here, this column where it says total amount of loans delinquent 60 plus days, this does not even account for this first column right here, 30 to 60 days. So like, just to kind of share with you the methodology that, is being used for what I'm about to share, we're not even counting anything that's less than 60 days delinquent, right? We're only counting things that are really greater than 60 days delinquent, less than 360 days delinquent, right? Because after 360 days, then it's just considered a charge off. And then that's going to filter down to this section over here where we have charged off amounts. And again, I'll share with you the findings, but let's go over. I wanted to just give a real quick recap of the initial analysis that we did. So This was just looking at the total amount of delinquent loans, 60 days plus, and really looking at it year over year. So in the last analysis, we had March 31st, 2023 compared to March 31st, 2024. And overall, we see a huge increase in the dollar amount of delinquent loans. So just giving you sort of a summary, it went from $1.2 billion to almost $2 billion. So right down here, as you can see, this was a 61% increase year over year. So the total dollar amount of delinquent loans increased by $740 million between March 31st, 2023 and March 31st, 2024. All right. And this column over here is just, so this is really just looking at the dollar amount. This is looking at the actual number of loans. So I'm not going to focus too much on that. We're really just going to look at the dollar amount. But as you can see, these are all double-digit percentage increases, right? So just some things to highlight where we're seeing the largest spikes are obviously going to be with unsecured credit cards as well as new vehicle loans, right? So those had the biggest percentage jumps. Now, I'm not really going to focus on these right here. So numbers 8 through, let's say 20, and 12 to 20 is grouped with commercial loans and lines of credit. I've just abbreviated that for the purposes of this analysis. We're really going to focus on a lot of these personal accounts. So unsecured loans, new car loans, used car loans, and all other unsecured personal loans and lines of credit, because that's where most of the volume is going to be. Also, when we're talking about secured first lien, single 1 to 4 unit family residential properties as well, that's going to have a higher dollar amount, obviously, because homes are, more expensive, or the price or the mortgage on a home is going to be a lot bigger than, let's say, a credit card, for example. So we will take a look at that. Now, what I wanted to really do for the purposes of this analysis is really look at 2024. So far we have Q1, which is going to be in this column right here. And we also have Q2, right? So all this information is complete now. So let me just zoom in a little bit so you can see a little bit better. Actually, let me zoom out a little bit. Okay. Now, looking at the unsecured credit card loans, right? So in the first quarter of 2024, $815 million that was delinquent 60 days plus, right? So again, looking at the total figure, $1.95 billion. It increased to over $2 billion. So the total increase in delinquent loans just overall, 60 days plus, increased by about $53.5 million. So this was a 2.7% increase from the ending of the first quarter of 2024 to the ending of the second quarter in 2024. So overall, $53.5 million increase in delinquent loans 60 days plus. That's just overall. Now, here's where I want to just, give you some caveats to really think about. So when we're looking at credit cards, for example, right? Let me zoom in a little bit more here. So when we're looking at unsecured credit cards, it decreased by $26 million. So this was a 3.2% decrease in the total dollar amount of delinquent credit cards 60 days plus. Now, there is an explanation of this, because remember, just going back to what I showed you on this page right here. So after 360 daes, it goes to the charge-off column, right? So it's not even going to show up anymore on this page. So as you can see in the credit card column or row, which is the first row, unsecured credit cards, after 360 days, as you can see on all these call reports for these three categories, right? So these first three categories, when we're looking at unsecured credit card loans, payday loan alternatives, and non-federally guaranteed student loans, after 360 days, it just goes to zero, right? Because it's now charged off. So that explains why we see this decrease in the total dollar amount of delinquent loans. Another thing that could also be contributing to this is the fact that Navy Federal has also increased their underwriting. So I think it's going to be a good thing overall that they increased the underwriting, because hopefully by doing this, it's going to somehow curtail the number of delinquent credit card accounts, right? But just to kind of explain this, this is looking at, year to date. So we do see a decrease, but just remember, I would say a good portion of this, or perhaps all of this, just went to the charge-off column, right? So that's just one thing to really think about when interpreting this data, right? So after 360 days, it just goes directly to charge-offs. And the other categories I wanted to just highlight as well, when we're looking at the new vehicle loans, so that it actually increased by 14% quarter over quarter, from Q1 to Q2. So from about 83 million to 95 million in new car loans that are 60 plus days late. And that makes a lot of sense because we're seeing a lot of repossessions now, these expensive vehicles. But overall, when you're looking at this 12 million increase, in the grand scheme of things, is probably not that large, especially because Navy Federal seems to originate more used cars. So when we're looking at used cars, the used cars increased by $22.7 million. So that was about a 10.7% increase. And then, again, I'm not going to focus on these categories necessarily, but when we're looking at first lien, single family residential, it increased by $41.6 million, or about 7.3%. All right. So we are seeing a lot of increases nonetheless. But again, with the credit card accounts, those do go to charge-off status. So that could account for the decrease we see in the total delinquent, right? And then also right here, as you see, the total number of accounts actually go down, because again, we're moving it from delinquent to charge-off, right? So that decreased by 3.8%. And then for some of these other categories, again, used car loans, new car loans, that did increase, and as well as first lien residential mortgages, that also increased. And again, smaller volume or total number of accounts, but higher volume in terms of dollar amount, because again, mortgages are much more than credit card limits, right? So again, just wanted to give you guys this quick analysis, right? So what I really wanted to hone in on is the year-to-date charge-offs, right? So as I was saying, this is just looking at from the first quarter of 2024, so through March, and then looking at through June, right? So this is just, again, a comparison quarter to quarter. And this has both year-to-date charge-offs as well as recoveries, and we'll dive into the recoveries as well. So when looking at unsecured credit cards, right? So Navy Federal charged off $575 million in credit cards in the first quarter of 2024. In the second quarter of 2024, they charged off, and again, this is year to date, right? So not in addition, but year to date. So year to date, as of the second quarter, the ending of the second quarter of 2024, $1.15 billion in credit card charge-offs. So when we look at the change, that was $580 million. So one way to look at it when we're looking at the change, that actually is basically like the Q2 charge-off, right? Because this is year to date, this is also year to date, but only up into the first quarter. This is year to date up into the second quarter. So when you subtract this 580 basically means that in Q2, so between April 1st through June 30th, an additional $580 million in credit cards were charged off by Navy Federal Credit Union. So as we can see, the charge-offs have actually increased, right, from 575 in the first quarter to 580 in the second quarter, for a total of $1.15 billion just through the first 2 quarters of 2024. So when you look at that, I mean, that's not good. You know, 580 million that is charged off, right? And another way to interpret this data, right? So when we're seeing these in terms of year-to-date charge-offs, when we look at these percentage changes, so when it's over 100%, that basically means that these charge-offs in these particular categories is not going down, right? So if it's less than 100, that means, you know, charge-offs are kind of, you know, cooling off a bit. But as you can see, when we look at this column for every single category, you know, 100% change, right? So basically, the charge-offs are not decreasing from one quarter to the next. And actually, when we look at credit cards percentage-wise, so the difference between Q1 and Q2 was about $5.3 million increase from Q1 to Q2, but nonetheless, you know, we're still talking about hundreds of millions of dollars in charge-offs, you know, that are increasing from quarter to quarter. But looking at some of these other categories, right? So again, new vehicle loans, 111% change from Q1 or from Q1 to Q2. So in Q1, it was 28.2 million. In Q2, it was 31.4 million. So it was an increase year to date, $59.7 million. Used car loans, same thing, 103.5% change between Q1 and Q2. So in Q1, there was 88.2 million. In Q2, it was 91.2 million. And year to date, $179 million in charge-offs for used car loans. So again, all of these are increasing. So right here, where it says all other secured non-real estate loans, lines of credit, that actually did cool off a bit. But when we're looking at these numbers, all right, it went from 8.2 million in the first quarter to 7.8 million in the second quarter, right? You know, these are very small dollar amounts relative to some of these other loan categories. And then when we're looking at, for example, secured first lien, single family residential, this is interesting. So we actually do see a higher percentage increase, but again, just looking at the overall dollar amount, not that significant, right? But let's look at the total charge-offs from Q1, Q2, and year to date. So in Q1, $899 million. Let me zoom in a little bit more, right? $899 million in charge-offs in the first 3 months. So when you think about that, Navy Federal was basically charging off $300 million per month in bad loans, right? So 915 million in the second quarter. So it actually increased when we're looking at the difference between Q1 and Q2, it increased by about $15 million. So the charge-offs overall are accelerating from quarter to quarter, and that's not good news. So year to date through Q1 or through Q2 of 2024, Navy Federal has charged off $1.8 billion in bad loans. All right. So just keep that in perspective, right? So, and again, these are separate items on Navy Federal's balance sheet, right? The charge-offs, recoveries, as well as the delinquent loans. These are two separate categories that are not overlapping, right? So one way to think of it, the charge-offs are going to be, I guess, what they charge off as bad debt, and then the delinquent accounts are essentially what they are still considering as an active account, right? They haven't yet charged it off. Now let's look at recoveries, and I'm not going to spend a great deal into this, but when looking at the recoveries, so just a way to analyze the recovery. So with recoveries, you do want to see these percentages over 100. Over 100 basically means that quarter to quarter, more money is being recovered than the previous quarter, right? So just to kind of give you some perspective. So when looking at credit cards, in Q1, there was about 39.5 million in recoveries. Now, keep in mind, 39.5 million in recoveries. So that's money they were able to recover from these charge-off accounts. But again, that pales in comparison to the 575 million in charge-offs, right? So they're collecting a very small percentage of what was actually charged off, right? 39.5 million compared to 39.5 million in recoveries compared to 575 million in charge-offs. But when looking at the recoveries from the first quarter of 24 and the second quarter, the recovery actually did go down, right? So it went from 39.5 million in Q1 to 38.9 million in quarter two. Year to date, 78.5 million, right? So in just looking at this, right, year to date charge off 1.15 billion, year to date recovery 78.5 million. So, I mean, when you think about that, I don't know the percentage off the top of my head, but that's probably under what, 8%, 7%. Someone can check my math on that. So when it comes to charge-offs, you would want this to be under 100%. This change from quarter to quarter to be under 100%. When it comes to recoveries, you would want this change from quarter to quarter to be over 100%. So I guess one area where Navy Federal is actually increasing recoveries, as you can see right here, is going to be with the new and used auto loans, right? And again, this is a form of secured lending. There is some type of, recourse or collateral that they can, repossess from the borrowers to recoup some of the money. But with unsecured accounts, with credit cards, sometimes there's not as much for Navy Federal to really be able to recover, right? There's less recourse, I guess you can say. But as you can see with the recoveries for new and used vehicles, that actually is increasing. As you can see with, let me just scroll over to make sure. Okay, so with new vehicles, which is going to be 187% increase from Q1 to Q2. So in Q1, it was 2.3 million in recoveries, which is still a pretty small amount, considering how big Navy Federal is, right? In terms of the money that they're recovering. But then in Q2, it actually nearly double when you think about it, almost a 200%, 187%. So they recovered $4.37 million in quarter two to a total of 6.7 million through the end of Q2 of 2024, right? Used car loans, pretty much the same story. The recoveries seem to be increasing from Q1 to Q2. And again, that's because repos are increasing. So they're repossessing a lot of these cars and reselling them and recouping, some of the money, right? So that explains that. I'm not really going to dive into any of these because, again, we're talking about very small dollar amounts overall, right? So again, let me know in the comments section what you guys think about, these numbers, right? We see an increase in overall charge-offs, right? Navy Federal has already charged off, and this is just through the end of June. We're in August, right? So I'm sorry, September. So since these numbers came out, about 2 months have passed. So if they're on this same sort of trend of, about $300 million per month in charge-offs, right now, arguably, they could be at about $2.5 billion so far this year. And again, this is just based off of the trajectory they've been on so far, right? Now, another thing I wanted to highlight, let's go back to this call report, right? So, and again, I apologize for not putting this in an easier way for you to look at, right? So again, this is where I'm pulling all the data on the loan loss information, loan charge-offs and things like that. But another thing I wanted to highlight, right? So if you see right here, this item 27, borrowers experiencing financial difficulty not in compliance with modified loan terms. So if I scroll over here, as you can see, the total number of loans, right? So let me just reiterate this, right? This is what's described here. Line item 27, borrower experiencing financial difficulty not in compliance with modified loan terms, right? So this is 29,492 loans for a total of $819 million. So again, these numbers are staggering overall. Now, let's talk about, what are some of the reasons behind this, right? Because everywhere we turn, there's all this talk about Navy Federal, right? People running off on Navy Federal. I wanted to just go over this article real quick. This is from Credit Union Times, which is a news publication that shares a lot of news about what's going on in the credit union world. And right here, so this is an article that was published on September 4th, right? So just a day or two ago. Despite quarterly losses, credit unions find hope on the horizon, right? So some of the biggest losses of Q2 were a product of conditions that might already be improving. Now, before I dive into this article, I will say I think a lot of these credit unions have implemented measures in terms of their underwriting to curtail future losses given the current economic climate that we're in, right? So I think what we're seeing in the data right now is everything I showed you with Navy Federal are basically things that that have already sort of began to materialize. And so I do think based off of some of the measures that credit unions are implementing now, it will sort of help with the losses, but the losses that we're seeing through the data through Q1, Q3, and I would say probably through Q3 and Q4 of the rest of this year, is going to be based off of, conditions that, consumers are already going through. So I don't think we fully have seen this play out 100%. I still think there are going to be additional losses throughout the remainder of the year. But what I will say, and again, also supported by this article, is that some institutions have already implemented measures to where maybe a year down the road, they'll actually see some type of improvement because, again, it's going to be harder for people to get access to credit cards now. And a lot of you guys have shared how Navy Federal is being more stringent, being more strict. People aren't getting as approved as they once were. So again, a lot of the data that we're seeing are going to continue to play out, but maybe a year down the road, because of these measures that have been implemented in terms of underwriting, they'll probably see less losses, let's say in, let's say just this year or this same time in 2025, right? Because again, if they're implementing stronger underwriting, then hopefully that will, curtail some of the defaults and charge-off that they're experiencing right now. So basically this article was saying that there were a bunch of credit unions that had losses in the second quarter. And right here basically spells out some of the credit unions with some of the biggest losses. I'm surprised they didn't include Navy Federal in this, but First Tech Federal Credit Union, so they lost $12.7 million in the second quarter. You have Blue Peak Credit Union, Michigan State University Federal Credit Union. And so again, a lot of credit unions are experiencing losses right now, and I'm not going to go over the whole article, but let's try to, explain what's going on with Navy Federal, right? Like, why are we seeing a lot of these losses, right? So this was an article from a couple weeks ago. So it says 7+ years in prison for fraud ringleader who stole millions from credit unions, right? criminals circumvented credit union bank protections by using accounts that had been open for 5 years or longer. So this is very interesting because, again, as we talk about a lot of times with credit unions, especially Navy Federal, you have what's called an internal credit score. And usually that's going to depend on your relationship with Navy Federal. So the longer you're a member, the more history you have, the higher your internal score will be. And then a lot of times what institutions will do is limit your maximum exposure. Let's say if you're a new customer. So it's not like if you're a new customer, you're going to come in and get all these high limits and then, run off, right? They have measures in place where, again, you have this internal score. So just based on what I showed you right here, these fraudsters were creative and actually probably had an understanding of the bank rating and the internal scores at these institutions where they were using accounts that had been open for 5 years or longer, right? So meaning like more than likely going to have a strong internal score. Right here, this was just, talking about this conspiracy where this individual stole $2.7 million from a handful of different credit unions. And again, this was in California, right? Here's another example, right? Navy Federal members threatened with curses in an alleged scheme. So right here it says church members were encouraged to open Navy Federal accounts with PPP loan funds, which were later deposited and allegedly paid for pastors' lavish lifestyle, right? Right here, this is another recent case. And again, all these things I'm showing you are within like the last, 2 months, right? All around Navy Federal, right? So right here it says police make third arrest in ongoing Navy Federal fraud investigation. So there's a lot of these examples of, people abusing Navy Federal, right? People running off on Navy Federal. So just to read this a little bit, it says Georgia police said Wednesday a third person has been arrested in an ongoing $800,000 fraud investigation of a former Navy Federal credit union employee, which also involves Navy Federal accounts belonging to a street gang member and a dead man. So, even, not to mention the customers running off, but you also have, insiders who are also committing this fraud. So, all around the board, Navy Federal is getting, used and abused, right? So right here it says, the investigation revealed that 2 checks totaling $122,000 were deposited into a Navy Federal account belonging to someone who is currently incarcerated in federal prison, right? So people are finessing Navy Federal, right? And again, Navy Federal is the largest credit union, but Navy Federal is not a Chase. Navy Federal is not a Bank of America, right? Navy Federal is large in terms of other credit unions, but comparing Navy Federal to a Chase, we're talking about, $100 billion credit union versus a multi-trillion-dollar bank, right? So it's not the same comparison. So I think, eventually a lot of this, things are going on, the defaults, the fraud is going to cause these institutions to change up their processes, right? Become more stringent in underwriting. And that overall is going to affect, everyday people who are just, trying to utilize their banking services. Here's another example right here. And again, this is from a little bit earlier, maybe like 4 or 5 months ago, but 6 Navy Federal members face felony fraud charges, right? So members allegedly deposit fake checks into their accounts after targeting elderly bank customers, right? So just another example of people trying to finesse Navy Federal. Now, again, a lot of those cases, it seems like it was more of like, check fraud and stuff like that. A lot of like the credit cards and, people using CPNs and getting all this funding, most of that's not going to make the news, so you're never going to hear about it, but it is going to play out in a lot of the data. So a lot of these call reports that we've been looking over and just, looking at what's going on, how are things trending, what are the defaults and the charge-off rates looking like, how is that, increasing or decreasing year over year, in between, what categories are we seeing these changes in? And so I just wanted to share this with you. So just to kind of recap, right? So through the second quarter of 2024, Navy Federal has charged off approximately $1.8 billion, right? And another thing I wanted to share with you as well, right? I know some people were like, well, it's not that big of a deal. I wanted to go back to the March 31st, 2023. So this is what I used in my first analysis, right? So just so you see this report right here, this was March 31st, 2023. So in the first analysis I did, I was comparing, Q1 23 to Q1 24. So I didn't dive into the charge-off information, but I did want to just highlight this real quick. So right here, it shows, as you can see, this was in Q1 of 2023, right? So the total charge-offs up until that point, $580 million. Now let's do another comparison a year later, right? So let's look at March 2024, right? So as you can see, this is March 2024. You see the date up here. All right, so let's go to this same page right here where it shows Section 3, loan charges, loan charge-offs, and recoveries, right? So right here we see $899 million. So again, in 2023, the charge-offs was 580, right? So you see 580, and then a year later, 899. So what's the difference? So let's just round that up. Let's just say 900 million and 580 million, right? So that's over like a $320 million increase year over year. So Q1 of 24, Q1 of 23 to Q1 of 24, the charge-offs increased by $320 million, right, in just 1 year. So that's pretty significant. So I just wanted to highlight that as well, just to kind of share with you the direction of where this is heading, right? And again, I think Q3 and Q4 are also going to show more increases in charge-offs, right? Because they're not done yet. The economy has not technically, recovered to the point where, consumers are able to pay down their debt. So we're going to see additional pain when it comes to these delinquent accounts and charge-offs and things like that. But I did want to just illustrate how it has been progressing for the worst. But I think overall, because credit unions, financial institutions have tightened up underwriting, we're not going to see that improvement probably for another year for that data to play out. But right now, and I think we're probably in, I'm not going to say at the peak, but I feel like we're slowly approaching that peak. And then hopefully once interest rates go down, we'll get back into that quantitative easing and, easy credit and just start that cycle all over again. But anyways, let me know what you guys think in the comments section about these findings, any comments, questions, feedback that you have. That's all for today. Until next time, take it easy and we'll talk to you soon. Peace.